Welcome to this channel today. And today we are going to look at how to read currency pairs and then how you can profit in the forex market. How do traders make profit? These are When we are done with this video, you will understand the common mistakes, especially beginners and forex traders make that end up making them lose profits they've had already in the forex market, or at the end of the day take trades that will end up in losses. So stay on and then stay put. Watch the video to the end so that you understand how you can make profit and how you can read currency pairs in the forex market. Don't forget to like, share, and subscribe. Turn on the notification bell so that you get notified when subsequent videos are dropped. So, but do well to make sure that you've watched the last videos before joining this one, because it will give you a deeper understanding of what we are talking about, because we are starting from currencies where we stopped in the last video. Now, we've talked about in the last video all you need to know about currencies and how they are grouped. So, but here, when we talk about how you read currencies, don't forget in the last video we said that currencies are traded in pairs, right? Fine. We are not going into that because I wouldn't want this video to be long. So watch the last one so that you get everything in full. So we said currencies are traded in pairs. So here, how do we read those currencies that are traded in pairs? Just when we say in pairs, we mean in two, just like you have a left leg and right leg of a shoe. So let's use USD for instance, is a pair, okay? And then when we talk about pair, we mean that the two currencies that come together form a pair. So, and when we look at them, you see the first currency is quoted, the second currency is quoted with it. Some brokers will differentiate them, maybe using a forward slash, using a dot, writing them together, using versus like VS, maybe USD versus VS, and then JPY. So they can put anything in the middle to differentiate this from this. Do you get? Or they can bring them together. So here we are looking at why are they quoted in pairs? They are quoted in pairs because of foreign exchange transactions. Okay, the buying and selling that happens in the forex market. That's why they're quoted in pairs. Because for there to be a buying and selling going on, that means there should be a buyer and there should be a seller. So that's why these currencies are in pairs. Now, when you look at these two currencies, just like we are using USD JPY, for instance, that's United States dollar and then Japanese yen. Like we're looking at them as an instance. Now, the first currency I mentioned is United States dollar, USD, and then it's quoted against the Japanese yen. Now, the first currency listed that is always by the left-hand side is known as the base currency. Now, we are looking at reading currency pairs now. Is known as the base currency. For instance, that we have USD JPY. So that USD, that is the first currency, is always at the left hand side. It's called the base currency. If you have Euro USD, you have a GBP USD, you have a Euro JPY, whatever you have, the first currency on the left hand side is always the base currency, while the second currency on the right hand side is seen as the quote currency or the counter currency. And in this case, the JPY is the counter currency or the quote currency. Just like we are using our reference point is USD JPY. Now, what happens to let's look deeply into what the base, the quote or the counter is all about. Now, the base currency is the basis for the buy or the sell in the forex market. So it has to tell you that for that USD JPY, when you click buy, that means you're buying the base currency. When you click sell, that means you are selling the base currency. So that's why I said the base currency is the basis for the buy or sell that takes place in the forex market. And here our point of reference is USD JPY. So that means if we click on buy, when we get the pair USD JPY, if we click on buy, that means we are buying USD. If we click on sell, we are selling USD. Okay, now let's look at what happens to the Japanese yen, the JPY. Now for the JPY is seen as the counter currency or the quote currency. Now it's called the counter currency because just like in football, when a team attacks, goes for an attack, do you get, and then they loses that attack in the forward, the opponent launches a counter. It's called a counter attack. So counter to show you that this is opposite of what happened. I don't know if you get that analogy. So with that analogy, you should understand that the second currency by the right, that is called counter or quote currency, counters what the first one does. So by the time you're clicking buy on USD JPY, that means you're buying USD, and simultaneously and automatically the algorithm of the market sees it that you are also selling JPY. So this is what happens. This is the algorithm of the market. You don't see it. I don't see it. If you watch the first video when we started with what Forex is all about, you will understand when I mean when you go to make your exchange. You give this to take this. When you go to Bureau days, and please just watch the last videos and then you get everything fully. So when you click sell on USD, that means you automatically buy Japanese yen. These things happen simultaneously. That's the way the market sees it. So you click buy on USD, automatically you are selling JPY. You click sell on USD automatically. So whatever you do to the base currency, the put currency or the counter currency does the opposite. Since everything we do in the forex market is based on the base currency, what do we do? So for you to place buy, that means you believe that the base currency will appreciate, that's it will go up relative to the quote currency. That's you place a buy. And then you will only place a sell when you believe that the base currency itself will depreciate. That's it will go down relative to the quote currency. So the base currency is the first currency in any currency pair, and the quote currency is the second currency in any currency pair. Now, if we look at how we can profit in the forex market, now most traders move into the forex market because you have a strategy, you have a pattern, you have a risk management, and then you feel like, okay, fine, you know your risk appetite, you know your strategy very well, you have your risk to reward, and then most traders feel with all this they can actually just take a trade, keep buying, keep selling, and then you make profit. Because in the forex market, you don't only make profit when the market is going up, like when it's buying, when it's bullish. Okay, you also make profit when it's selling, when it's bleeding, when it's coming down, when it's bearish. Okay, so but we need to know what we have that moves the forex market, inside the forex market, so that you know how you make profit in the forex market. Okay, the object of forex trading is to exchange one currency for another in the expectation that price will change. So the currency you bought will increase in value compared to the one you sold. Now, when you look at the one you bought and the one you sold, don't forget that this is still one currency pair. That's the base currency and the quote currency. Forex trading, we look at exchange rate. Exchange rate. When we talk about exchange rate in a layman's terms and definition, we say that it is the price of one currency expressed in another currency. So if we are talking about the exchange rate of US dollar against Nigerian naira, is the rate of US dollar expressed in Nigerian naira. or expressed in Japanese yen. Do you get? So that is exchange rate in a layman's understanding. Exchange rate. So in the forex market, what goes on there, the market sees it as is exchange rate. By the time you're looking at the base currency and then the quote currency, is the exchange, you make profit from the exchange rate of this against this or this compared to this. Exactly. Now, an exchange rate is simply also the ratio of one currency valued against another. Let's say, for instance, we've been using USD JPY. Let's say we go with USD, same USD JPY. Now, the USD JPY exchange rate indicates how US dollars can purchase one Japanese yen, or how many Japanese yen you need to buy one US dollar exchange rate. This is what happens in the forex market, and we see happen in the forex market that most traders fail to understand. Now, follow me through. Let me explain. Now, when buying, if you decide to buy, the exchange rate tells you how much you have to pay in units of the quote currency to buy one unit of the base currency. So that's to tell you that if you want to buy the US dollar, which is our base currency, the exchange rate tells you how many of Japanese yen will give you $1. That's for when buying. Okay. Now, when selling, the exchange rate tells you how many units of the quote currency. Don't miss it. Here, when selling now, we have to look at what the exchange rate tells us, and it tells us the units of the quote currency you will need for selling one unit of the base currency. Here now, we are now looking at how many of Japanese yen that will offer us the one unit of US dollar. Okay, now don't forget I said initially that the base currency is the basis for your buy or your sell. So you can profit from forex trading by correctly determining whether one currency pair will go up, that's will appreciate or will strengthen, or go down relative to the other currency in the pair. We are looking at a pair. So we'll be looking at US dollar versus Japanese yen, so USD JPY. That tells you that with Forex, you can profit whether the market is rising or falling. This is because currencies are traded in pairs. So while this one is buying in a pair, while this one is going up, this one can be coming down. While this one is bullish, this one can be bearish. So, and your ability as a trader to determine that this currency is strong and this currency is weak, and then you now take your trade, that gives you the profit you need. So the ability as a forex trader is for you to know which currency is strong and which currency is weak, and you pair them. You pair the strong against the weak, and whenever you pair the strong against the weak, the analogy is buy. If you decide to pair the weak against the strong, that's when you can now sell. Because it's weak, it's going to drop. And this one is strong, is going to buy. So when you sell, you're automatically buying this one. And for the other one, when you pair the strong against the weak, that means you're automatically buying because this one is going to sell. This is what happens in the forex market, how the algorithm of the forex market is programmed. And if you have this knowledge, by the time you have your strategy working with it, you end up hitting your TPs on a regular. TP means take profit on a regular. I try to see if I'll water down the terms and terminologies in the forex market so that you will understand these definitions from a layman's perspective. Somebody moving into the forex market today can go through these videos and understand every single thing. without being bogged of, okay, what is this, what is TP, what is SL, and what have you. So at this point, we'll call it a day in this video. Thank you guys. Do well to like, subscribe, and then share the video. Don't forget to turn on the notification bell so that you get notified. More videos are coming. Thank you.